On the topic of monetary union, one can go on for a very long time. Okay, let me try about 40 minutes or so. For me, it's no problem at all if you have questions in between to interrupt me. It's sometimes very useful for me because it tells me where your interests are, and if I'm saying things that you already know, then just tell me. Go on. Many thanks for the invitation. It's a pleasure to be here. As I said earlier, I don't come very often to Norway because this country doesn't have problems, or at least only what we call luxury problems. But down there in Europe and in Euroland, we do have some problems. And I wanted to briefly give you a view of what I think is the problem, which might be different, a little bit different from the official agenda. And then I want to say a few words about actually what could be done about this problem, which I perceive to be the important one, which is for me financial stability. Financial stability, especially in a cross-border sense. That for me is the key issue in the euro area, and that needs to be addressed by what's called a banking union. But you will see that for me that is also enough, and my main thesis at the end is that there's actually no need for going beyond a banking union, no need to have a fiscal and a political union. But I will talk a little bit about that. If you're interested, we can later talk about other aspects like competitiveness, the role of Germany, and so on, where again I have my views which are a bit different from the mainstream, but there's only so much one can do in one seminar. Okay, so this basically says what I want to say at the beginning. The problem in Euroland is the banking union, which doesn't work or which doesn't exist, and that creates the instability. And we, of course, hope to go towards a situation where we do have a banking union, therefore a stable monetary union. But let me just gallop through the genesis of the euro crisis, which my view is fundamentally very similar. We had already over the last 10 years excess savings in Northern Europe. Actually, I should basically include Norway in this. It's not in the euro area, but it contributes to the European savings surplus. Within the euro area, most savings arrive at banks. Norway's, of course, the external savings are different because you have a sovereign wealth fund. But within the euro area, excess savings arrive at banks, especially in Germany and Holland. Banks can only invest de facto in their own currency, in euro. And they can invest only in debt, not in equity. So that means the banks had to invest somewhere in the euro area in debt instrument. But all this took place during a boom when everybody thought there's no problem. Growth will be there forever, and credit is not a problem. And as we all know, these things go on for a long time until they don't go on because people discover that the amount of debt accumulated by the debtors is perhaps more than they can bear. And then from boom turns into bust. And the one thing that happens at the time of the bust is that assets which were regarded as safe, like Greek government bonds, Italian government bonds, and similar things, suddenly become toxic. By toxic, I mean something very precise. Toxic, I mean these are suddenly assets which are risky, but risky in a Knightian sense. It's a risk which you cannot evaluate. It's not a known risk. And the problem is that the assets, Italian, Greek, and other government bonds, had been accumulated by institutions and people who wanted to have safe assets. So you have a boom, people accumulate this big mountain of things which they thought they were safe. And suddenly you're looking at the same and saying they're no longer safe. And they're risky. But I don't know what really the risk is. And I, German pension fund, whatever, I don't want to have any risk. So this stuff is toxic, away. Away with it at any price, basically. And that's when you have a financial crisis. When a large amount of these assets suddenly become impossible to value, they go on the market and price goes down, and when the price goes down, many institutions which hold a lot of them might go insolvent. Now, it didn't quite come to a breakdown of the system. Why? Because the ECB and then the ESM intervened to keep the South alive, because it's quite clear that if the southern countries accumulate a lot of debt and they're being asked to repay them today, that they can't. No enterprise can repay all of its debt. Might pay interest and amortize a little bit, but when these pension funds are sitting there, they want to have their money back today, because this stuff is toxic, and that is, of course, which created the problem. So this is the genesis of the crisis, and one important point you have to keep in mind there is the difference between stock and flow imbalances, which is very important. The flow imbalances were the fact that the southern countries had current account deficits, and the stock is when you accumulate a certain debt level. A crisis usually arises when you have a large stock of debt, which you have difficulties in servicing, in which the market no longer accepts. So the point at which we are right now is that the flow problem has much diminished, current account deficits, but the stock problem, as usual, stays. You cannot get rid of a stock of debt very quickly. So here you see the flow problem, the current account deficits. Notice, actually, this group of countries was in surplus. Germany was in deficit in these years. So down it goes, deficit. I think on average then over 200 billion per year, and then up again. So in that sense, there is adjustment that's taking place, but of course the stock, the 1,500 billion accumulated in the meantime, that stays. And this is stuff which has to be held willingly by somebody. 1/2, by the way, of the stock problem is Spain, to give you an indication of where the problem is. Okay. Now, why are these cross-border flows no longer financed? Because we have national supervision still of the banks. And the German supervisor says to himself, should I allow my banks to invest in Italian bonds? If it goes well, they make a small profit. They get 3% instead of 1%. But if it goes badly, they might lose a lot of money, and I will be responsible. So when in doubt, I say no. Don't invest in anything which looks toxic today. And also from a purely technical point of view, when you have ratings downgrades, the German supervisor looks at a German bank giving a credit to a Spanish bank, even if to a Spanish enterprise, even that enterprise is safe and sound and that nothing changes, if the country is downgraded, the German supervisor will say, okay, this is more risky, hold more capital. And in time and bank capital is very expensive, that creates another barrier to cross-border capital flows. And of course in the south it's symmetric. They also try to keep the money at home. That's what's called ring fencing. Everybody tries to keep capital liquidity at home. There's a well-known case of a Italian bank which bought a German bank in the 1990s, UniCredit, and they have a German subsidiary in Bavaria, which generates a lot of excess savings, like all of Germany. But the German supervisors tells this banking group, you can't transfer the funds from Bavaria to Milano. That would be an unacceptable risk. So you see the barriers that arise, right? Deutsche Bank has a subsidiary in Italy, and the German supervisor tells Deutsche Bank, you cannot use your funds in Germany, your surplus funds in Germany, to finance investment in Italy. And everybody does it, not just the Germans, it's basically everybody. It's not legal, by the way, but it's being done. So the psychology and the supervisory actions, they combine to limit these cross-border flows, with the result that you have in the south a credit crunch and high risk premium, and in the north, of course, liquidity glut and negative interest rates. Consequence, of course, for the real economy is clear. In the south, it contracts. In the north, it expands. Right? Mirror image of the last 10 years, but in a very sharp way, Okay, let me put that into in a picture. So before the euro area, you have liquidity, this blue stuff, which is distributed by the market all throughout the euro area. With the boom, national borders don't matter. And then, maybe by mistake, no, pushed the button here because, did I push a button here on the side by mistake? Okay, good.
Next one.
Yeah, okay. What happens? South of the Alps, nothing moves. Along the Rhine also. So all the liquidity in the north accumulates. That's the liquidity glut which I mentioned earlier, right? Which comprises, by the way, Switzerland, which is now an honorary member of the euro area because it is packed, and Norway, which basically also has this very large savings surplus. So that happens when the liquidity is stopped at the border. And of course, now the South would really get into trouble if it weren't for the fact that you have an institution which distributes some liquidity. That's the ECB. That's what's keeping the South from getting completely desertified. And of course, we have still another institution that's much smaller in Luxembourg, formerly EFSF, now the ESM, which also distributes some money. Right? These are the famous target imbalances, about which you have heard, I presume. 1,000 billion of German and Dutch and other banks at the ECB. And then on lend to banks in the periphery. And this is the ESM, which has lent only 300 billion, so it is in that sense marginal. That's my view of the crisis. The ultimate stage of the crisis, which was threatening to happen, but really didn't quite happen, would have been if the money which is pumped south by the ECB and the ESM then returns north. Right? That was what many people wrote about. They said, okay, ECB gives money to Italian banks, and then the Italian savers bring it back, right? Or from Greece, capital flight. That did happen a little bit in Greece, but fortunately, it did not happen on a large scale in any other country. So this is where the crisis, fortunately, stopped in the sense it didn't get worse. This capital flight didn't happen a lot. Okay, now we have that situation right now. It's getting a little bit better. A little bit of the money flows over the Alps, right? So it's no longer that severe. But the question is what to do. Of course, there we had the intervention of the ECB, which basically said the euro will not end tomorrow. And that took a lot of the heat out of the markets because everybody knows the ECB has enough hiring power to make sure that the euro does not disintegrate tomorrow. So at least for short-term capital flows, that was very important. But then, of course, that doesn't solve the problem of the underlying stock imbalances, because there are all these there's all this Southern European debt around, which has to be held willingly by somebody. And that somebody has to believe that he or she gets the money back. It has to be a stable system. And that's why I think we have to create a system which is stable, which can actually absorb shocks. And that is, in my view, the key issue right now, namely the banking union. Let me say a few words about what are the essential elements of a banking union, and then give you an illustration of why it is so important. But it's actually much more important than many people realize. Okay, the elements. Usually you say that the banking union has 3 elements. First is supervision. That has been agreed in principle, which is called the single supervisory mechanism. Notice the word mechanism. It doesn't say we'll have a single supervisor, But we have a mechanism. It can't be done in a clear way in the EU. It has to be something complicated which involves the ECB and national supervisors, but that's how life is in Brussels and the euro area. So that is agreed in principle. ECB will take over and be the supervisor de facto for the 200 largest banks. I mean, that's already an extremely important step. The second element would be the single resolution mechanism again, not a single resolution body, but a mechanism where everybody or most people agree on the principle, but nobody really agrees on the details. There the details become very important. And then on the last point, common deposit insurance, my view is that it is an essential element, but it has been basically pushed off the agenda because Germany says no, no. If you talk to German policymakers in private, they say probably it's needed, but it's just not politically feasible. If you mention the word deposit insurance, German savers will think that their money will be used to repay the Greeks. So that's the discussion as it is going on right now.
Can I ask a question there?
Yeah.
Common deposit insurance, I mean, there are directives about standardization of common deposit insurance, but there is an actual pooling of risk in that. Exactly.
There's a proposal from last year to have common standards, but that's really secondary. And then the one thing which the Commission has added is the proposal that national deposit insurance corporations or institutions could lend to each other in case of a large shock. But if you take, let's say, Ireland, the moment the Irish banking system is in trouble, nobody wants to lend to the Irish deposit insurance system because it's broke.
The UK did it for Iceland. But
I was going to say, you said it. And it's actually not likely to going to see its money back. So that is very annoying. But my view is that we need something. I will show you later what my idea is, which gets a bit around the problem of Germany. Now, supervision at the European level, I'm a fan of it. Because actually what we have had so far in Europe has been supervision at the national level, which always has led to national champions. The national supervisor has never seen the problems emerging in Ireland and Spain. In Germany, the national supervisors didn't see any problem with the Landesbanken, which were making losses for 10 years at end and have now to be had to be rescued by the government. So I think it is very good to have supervision move to the European level because the heterogeneity of different interests. In Germany, they have their special forms of indebtedness, the banks, and they lobby, of course, their supervisor to defend that international fora and to give them special dispensation for risk premium and everything else. So I think that will be much less likely to happen. One example, one of the unsung heroes, I think, in this crisis is a body of which you have heard very little, but has been extremely important. That's DG Competition. They had to vet all banking and restructuring mechanisms for state aid. The only body in Europe which has pushed for at least some write-down of at least subordinated debt is DG Competition. National authorities have always said, no, can not be any write-down, any bail-in of private creditors. That would be bad for our markets, forever, for our friends who have bought this stuff and whatever. And that's why I think DG Comp has been extremely important in at least providing some bail-in, and it shows that it is possible to withstand the pressure of national special interest groups. And of course, when we have this at the European level, the ECB would not tell UniCredit, you cannot transfer funds from Germany to Italy. For them, it's one entity. So that, I think, would go a long way towards reducing these intra-euro area barriers to capital flow. Now, after this supervisor created, everybody agrees that we need a single resolution, because if the supervisor says game XYZ, game up, then we need another body that takes over and makes sure that it's just not a failure like Lehman, but an orderly resolution. And Orderly, of course, means that you have to be able to put some money in there. And that, of course, also holds out that the possibility that this feedback loop between sovereign and banks will be diminished. But only if you don't have national restructuring funds, because if there's a national restructuring funds, you don't escape this vicious circle. And I must say, this is something which has not been decided. Sounds strange. Lots of idea about this around in Brussels, but there's no concrete proposal yet how it will be done. Because everybody's, of course, afraid that he will pay for everybody else. In the first instance, of course, the Germans. And I must say, some of the Italians and Spaniards have been suggesting that, oh yes, we have such a mechanism, and then they take over Bankia and basically pay off all the losses. This is very not very appealing. So the so-called legacy assets are the biggest problem to implementing that stuff. That's all under discussion right now. Nothing decided yet. But say the logic for having a European-wide single resolution mechanism is very strong. Presumably, it should be financed by industry. Presumably pre-funded, but nothing that is clear, because at the national level, that doesn't exist yet. What would be the governance? Would it be an independent institution? All questions which are unanswered today. But the key point is, of course, this resolution mechanism should be available, should be responsible for all the banks which are supervised by the ECB, and only those. But, and here comes my observation, it's very difficult to keep that independent of deposit insurance. If you have a bank which has large losses, if the SRM doesn't put any money in there, national deposit insurance will have to pay out. Of course, the national deposit insurance would like to have the SRM pay up so that they don't lose anything. So you see already a conflict of interest which is pre-programmed. And that's why my view is that resolution and deposit insurance are actually best combined, as there are in the FDIC in the United States. But perhaps the problem is a little bit different from what we perceive. My view would be it's the occasional failure of a single bank, even if it's a bit large. It's not really the problem. You have a problem, of course, of distributing the burden, but that would not bankrupt any country. The problem arises when the losses are so large that the sovereign of the country, the government, also gets into difficulties. So my view would be that if you look at deposit insurance and actually also at resolution, what you should look at is a system which basically provides insurance against large shocks. And that actually is something which is done in the insurance industry, and it's called reinsurance. In the insurance industry, you have many insurance companies which insure people against risk. Many of the risks are small and distributed, no problem for them. But once in a blue moon, a big shock comes along, larger than the insurance company can really pay out. And that's why it reinsures itself against very large shocks. And I think that would be very important, because that would mean, if you can have such a system of reinsurance, would mean that the national insurers would still remain responsible for their own local banks. But if losses get too large to threaten the entire system, then they could rely on somebody else to back them up against having paid a fee, of course, a reinsurance fee, exactly like in reinsurance. So my view would be that what you need is a Euro deposit reinsurance fund, which leaves the small cases with the national, what's called DGS, deposit guarantee schemes, and the larger cases then would be dealt with this European-wide fund. I've put that graphically here in this sense. So you have the banks in each country, they pay premium to the national deposit guarantee systems in each country. And then these are the insurance companies, if you want. These insurance companies go to a reinsurance company up here, pay premium, and have a contract which says that in case there's a very large shock, then you get something back. So if you have a small shock in one single bank, the national guy pays out, end of the story. if you have a very large shock at the national level, so if all banks go belly up, like Ireland, then this guy would also go belly up. But to prevent that from happening and prevent the feedback loop with the sovereign, it will then get funding from the European-wide reinsurance fund. Of course, the next question is always, what if the entire system goes belly up? Then, of course, you need the ESM or something else, right? By the way, I must say, Norway, with its very deep pockets, would be a good place to be provide reinsurance, because that would be a good use of the Norwegian capital. Because presumably Norway itself wouldn't be affected by crisis hitting any euro area country. Yeah.
This mechanism has crucially on your ability to price this risk.
Yeah.
And one of the problems compared to, for instance, pricing catastrophic risk is that that's exogenous to the economic system, and in particular to the mechanism you've made. But this would be quite endogenous. The risk building up on the system would be higher, the higher the belief that the system would actually save you.
Well, okay, I disagree that that moral hazard played a role, let's say, in Ireland and Spain, right? My view is that 90% was real belief, and not only by the Irish and the Spaniards, that this time is different. I mean, you're quite right. These very large economy-wide shocks, they emerge when there's a economy-wide boom or bust. My view is they didn't arise because people expect to be bailed out, but because there are these booms and busts which arise from time to time. Very difficult to predict why, and I will show you later also for the United States. You're right, it could be, but my view would be this reinsurer could take that into account. Look at the country and say, look guys, you're now imbalanced. You have a large current account deficit. 20% of your GDP is in construction. You have already too many houses for everybody. Things getting risky. So I think it would be possible to take these macroeconomic factors into account. And this reinsurer wouldn't need to look at every Spanish bank, but it would be able to actually look beyond that. Whereas the Spanish government or the Spanish insurer just looked at every bank and said, yes, capital ratios are perfect, we have even a countercyclical capital buffer, but didn't see the bigger picture of the bubble at the national economy. So I think that's something that can be taken care of. Okay. Now let me come to why banking union is so important, and you will also see something which should make you think a little bit about these localized bubbles. And here the United States is very interesting because it is and I think a well-functioning banking union. Not that the banking system always functions well, but the banking union part of it functions well. And it goes through two levels. One is institutional. You have federal institutions which distribute risk, Freddie Mac, Fannie Mae. These are the institutions which buy up individual mortgages, package them in securities, and then sell them on the market. And so that the risk is taken off from the local bank, which originated the mortgage, and is basically brought to a wider market. And then you have the FDIC, which is the Federal Deposit Insurance Corporation, which works quite well. Usually it comes on Friday afternoon at 5 o'clock. People arrive with different airplanes from different places, and they tell the management, sorry guys, you're out. Monday it will be somebody else's, we hang out a new name, and the bank continues. And if need be, we put some money in there, so make sure that all deposits are whole. And that's the way they do it. And if there are any bondholders out there, sorry guys, you have lost your money. Bye-bye. So they're very brutal, but also very efficient. And the second way in which the banking union works is that even if there's a localized concentration of, let's say, real estate risk, for a bank which operates throughout the entire United States, that's just part of the risk they're taking, and it can be absorbed in the much larger balance sheet. let me give you just one example. I have two, but let me just give you one example, which is Ireland and Nevada, which are two similar-sized states or entities. I think Paul Krugman has written about that. Actually, you see that they had both serious economic problems. Unemployment rate was very similar, increase, and actually had both net migration, which was outward. So in both cases, you had a huge construction bubble and a bust. Very similar. But in one case, the local banking system was completely bust. The local government close to. In the other case, Nevada, there's no such thing as a Nevada banking system, but in the government of Nevada didn't have any particular fiscal problems. So what happened? After the crisis, in the years following, the FDIC closed about 11 banks which were headquartered in Nevada. They had assets over 40 billion, so that's about 30% of Nevada GSP, gross state product. And the losses were about 4 billion, which the FDIC incurred in doing that, which was, if you want, like a gift to depositors in Nevada. And then you also know how much, for the first time actually, statistics have been published, how many of the losses Fannie Mae and Freddie Mac are making arises from defaults on mortgages in Nevada. And this data tells you that has been about 8 billion since 2008. So the direct loss absorption to the official institutions of the banking union in the US was around 12 billion US dollars, or around 10% of GSP. That's a very large transfer, especially for a country or a region in difficulties. And then, of course, on top of that, we know that the market share of the very large US banks, which operate nationwide, is around 50%. So probably they added, my estimate is another 10% of GDP of loss absorption. So the US federal banking union, through both its aspects, the market aspect and the institutional aspect, provided Nevada with a cushion of around 20% of GDP. Right? That is, I think, the way the banking union works in the United States, and that's why the crisis didn't lead to regional financial crisis in the United States. The US has nationwide banks. We have in Europe what we call foreign-owned banks. That has been a very important aspect, for example, in the Baltics, where most of the banks were foreign-owned, and the one bank which was not in Latvia was the one that caused all the trouble. Of course, again, these banks absorbed the losses. But even more importantly, they have a skin in the game. Okay, they have a loss, but they ask themselves, is it worthwhile to stay? Or do we just say we get out at any price? They can't, because they have the equity in there. So they're much more likely to stay in there and continue to provide credit for new endeavors, for new investment in the export sector. Okay, let me jump over that. I think it's quite clear for the Baltics it was very important. For Spain, not. For Ireland, perhaps marginally. Now, what is also important is that in the EU, we had, as I said earlier, an integrated capital market. And usually you would say an integrated capital market contributes to providing some risk sharing. Unfortunately, the way our capital market was integrated, it provided no risk sharing at all. Because any product which provides for risk sharing, like equity or subordinated debt, was sold domestically, and cross-border was in debt, sometimes even double guaranteed debt, like what are they called, the covered bonds. So the way of integrating capital markets actually created a problem. If it had been more like the US in terms of securitization, then we would have much less of a problem now. Then the northern investors would just have had some losses, but the south would be much easier to have a much easier way to adjust. As I said earlier, the US is a banking union, that's FDIC and Fannie Mae, but basically the underlying construction is that of the housing finance. That's extremely important, which is federally organized in the United States. And housing finance is, of course, something which remains very national in Europe. That is not something that we can imitate very easily. So my view would be that what we need in Europe is such a banking union instead of a fiscal union. It's really important shocks are not business cycle shocks, a little bit up and a little bit down, but are these shocks which come from time to time. They are rare. But when they come, they're catastrophic. And we need insurance against that through a system where we have a system where deposit insurance at the federal level, resolution also, providing the fund. Therefore, from the outside, should a concentration of risk in one country occur. One additional aspect, of course, which makes the resolution in Europe, which makes the crisis more localized in Europe, is that banks hold a lot of their own government debt, which doesn't happen in the United States, which happens in Europe. Why? Because we have a regulation which says the government debt of any euro area country is considered riskless for any euro area country bank. Right? This regulation made sense under Basel when you had the principle one country, one money. So for Norway, the Norwegian government debt for Norwegian banks is of course riskless, because in the highly likely case that somehow Norway has a deficit and high debt level, in the end the Norwegian state can still print the money. So in nominal terms, domestic government debt is riskless. And the little trick that was done was to say, that applies for the euro area as well, where it's actually the opposite. The Italian government cannot print euros. So it's like foreign debt in euros, for Greece as well. And that meant the bank accumulated a lot of the debt, and even worse, concentrated in their own government. And you can imagine that the own government is always pushing a little bit on the regulatory side to do that. That is something which could have been corrected and wasn't. For those who follow things, the CRD4, Capital Requirements Directive, which has been finalized these days, contains the same old exemption for government debt. So that part, unfortunately, is likely to continue. So as I said, the really important shocks are the ones which are boom-bust cycles, which are followed by a financial crisis. Now, the one thing which I mentioned earlier is important to keep in mind. These things come in waves. This here is just a chart of the losses of the FDIC per year. So you see, this was savings and loan crisis, a lot, boring, and then again a lot. That's what they say about soldiers in war. Long periods of boredom and then short periods of intense activity, intense danger. That is the way deposit insurance and bank resolution work in practice. So hopefully now in Europe we have a period of calm, we don't know. But that's very important to keep in mind also in the construction of these entities. They're not normally busy every year, but it comes in very intensive bouts. And the second point is that these crises are usually very localized. Here you see the savings and loans, which was basically Texas here, and not the rest. And the similar you see for the present crisis. And now let me just make you think a little bit, because everybody says, yeah, the Irish, the Spaniards, they made these big mistakes and let their housing bubble develop, and it was all because of wrong national policies. You don't have state policies in the United States. And still, these booms and busts were very localized by state. So I think one has to question a little bit the point of view that moral hazard, that countries fostered these things and were counting on being bailed out. My view is that these booms and busts, they arise for reasons that we don't well understand, and they're almost always localized, even in rather homogeneous areas. So it's It's now too late anyway to assign blame. It doesn't really matter. But just to say it's the Spaniards and the Irish fault, I also used to believe that. It was certainly a fault that didn't recognize it, but these things are always localized. Now, a lot has been written about the strength of the US federal fiscal system. Many people have argued that is really the thing we need to imitate, because if there's a shock to a state in the US, then it gets money from the federal system. And to make a long story short, that is wrong. There are transfers in the United States. For example, Florida gets a lot of transfers from the federal system because many retirees, pensioners have moved to Florida. So lots of federal funds go to Florida, Social Security payments, because people live there. But if the Florida housing industry collapses, nothing much changes. And here I've given you just an idea of how much the change in federal, how important was the change in federal fiscal transfers to different states compared to the banking union effect. So I was talking about Nevada earlier, and Nevada got 1% from the federal fiscal transfers system and got about 8% here, this estimate, through the banking union. So if you look closer at the numbers, you'll see that the federal fiscal system in the United States provides very little shock absorbing, but when really large shocks are there, the banking union does provide a shock absorber. And I think that is the thing that we need to keep in mind for Europe. So my view would be that what we need is a banking union instead of a fiscal union. And of course, that means also there's no need for a political union. Idiosyncratic shocks at the national level can be buffered by resolution funds, deposit insurance funds, which are nationally administered. And then you have perhaps the reinsurance that I mentioned earlier, with a final backup by the ECB. And national fiscal policies under these circumstances can then just react to the normal business cycle shocks. That would be my vision going forward, which doesn't require a lot of fiscal policy coordination, but requires a strong financial system. By the way, when you have a strong financial system, then the creditor countries are also in a much more comfortable position to say no to requests for financial assistance. If the European banking system had been stable, then Germany could have said no to Greece. It's your problem. But if the banking system is not stable, then of course the Greek problem becomes a German problem. So perhaps this is more for the academically inclined. If you look at the mixture between banking union and monetary union, you can see different adjustment patterns. You have no monetary union, no banking union. That was the case of Iceland. Big problem comes, you say, okay, sorry guys, I can't pay. You default, and of course you have to adjust. If you are in a monetary union, the Baltics were on a fixed exchange rate, so de facto they were in a monetary union. But they were actually more in a banking union than people in the euro area because they're the foreign banks. So they're protected against losses via their foreign aid banks, although they didn't have central bank liquidity. So they had a brutal adjustment, but they didn't have a big problem with legacy assets or losses on legacy assets because these were on the books of their foreign-owned banks. Then you have the ideal situation, or ideal, the best one, which I consider the best one, which is the US. You have a substantial protection against losses from very large shocks. And the adjustments then market-led, but with markets which work. Not like in the periphery, and that would be the case here. You have some provision of liquidity from the central bank, as I showed earlier, but you have no loss sharing. Liquidity from the central bank allows you to delay the adjustment, but since there's no loss sharing, eventually it will be actually more difficult. And that's what we're seeing right now. They're getting liquidity, but the Germans say the losses are yours from the past. You got to pay up. And you're not allowed to default. So that is, I think, the way one should think about this, this situation right now, where we hope that we can migrate from here to here. So my view would be that a banking union is perhaps even more important than a formal monetary union, Baltics versus Euro area countries. And the key shop observer within a monetary union has to be some sort of banking union. And if that works well, I don't see a need for a fiscal union. And of course, then no need for a political union. That was, if you want, what the Maastricht system was supposed to have been. And it's just that everybody forgot about the importance of the stability of the financial system in the 1990s. I must include myself in that. I also didn't realize how important that was. But that is something which can now be corrected. And if it can be corrected, then I think we have a pretty strong institutional setup. Because with a strong banking union, national responsibility could actually be strengthened. National public finance would also be strengthened, and people have to be more self-reliant. And that, in the long run, I think, should be a pretty strong system. How complete our banking union will de facto be is very much open to question. Of the 3 points which I mentioned earlier, I think we'll get 1.5 for now. Supervision, a little bit of resolution. The hope is that as time goes by, our politicians see the logical need to go beyond resolution and, first of all, to full resolution at the European level, and secondly, for deposit insurance. Maybe with a system which, as I outlined, with some kind of reinsurance. That should be politically feasible. And if it can be done over the rest of this decade, then I think we are in for a much more stable monetary union. Let me stop here.